Very good morning, everyone. I am CA Gaurav Garg, and we would be starting our discussion shortly in a minute or so. Very good morning, everyone, and welcome to today's discussion on outstanding receivable controversy in transfer. I am CA Gaurav Garg, and I would be discussing this interesting topic or interesting issue with all of you. So we have friends, those who have joined on YouTube. Very good morning to all of you, and very good morning, everyone, and welcome to today's discussion on outstanding. And we have friends who have joined us on a YouTube. Before we start, my formal discussion, and whether it's a formal discussion that we have already started, I would like to know, your view on outstanding receivables. What do you understand by outstanding receivables, and what according to you is a transfer pricing issue when it comes to transfer pricing? The friends who are on YouTube, they can put a comment on the YouTube, and the friends who have joined us on a Zoom, they can raise their hand and share their view on the outstanding receivables. So may please raise your hand and I will allow you to speak. If you have something to say on outstanding receivable, what issues you are facing, how you are dealing, and in general, what you feel about outstanding receivable when it comes to transfer pricing. Anyone from the participants? So we have friends, those who have joined from outside India. Very warm welcome to all of you, and namaste from me. I would like to understand your perspective on outstanding receivables. Any friend, those who have joined, any one of you would like to share their view on outstanding receivable? Okay, I think everyone is waiting to hear me out. So let me start my discussion. Let me share my presentation with all of you. Okay. So see, when it comes to outstanding receivable from a transfer pricing perspective, we often enter into transactions with our group companies, with our associated enterprises, and there are cases, that you do not receive payment spontaneously. It takes time, and generally there would going to be a delay in receiving the payment, maybe for a day, maybe for a month, maybe for a 6 month, maybe for a year, maybe for more than a year. So when we think from a transcribing perspective, the question comes how to handle this delay and whether there should be any charge for this delay. So, for example, I'm supplying goods to my group companies or to my associated enterprises, and I'm receiving payments, in journal, let's say within uh, 15 to 20 days or 20 to 30 days. The question comes, should I charge the interest from my associated enterprises for this delay? Another case could be I'm receiving payment after 6 months, and there is a time lag of 6 months. So should I charge interest for 6 months? And when we all know, when we go to a market for, let's say, for our routine buying some vehicle or some, electronic items, generally you will find there's a difference between a cash price and a spot price, and if you're buying an item on a credit period, which means, there may be a case that if you're supplying goods to your associated enterprises, the price, is dependent upon the credit period. The price is already taking care of the credit period. But yes, it may very well happen that because you all are part of one group, the price may not take care of the credit period, and one may take an assumption that yes, it is taking care of the credit period, but the fact may be that price is not actually taking care of the credit period. Then we all know, for the transcribing professionals who are attending this program or who are watching this live discussion or a video maybe later on, we have an adjustment called working capital adjustment, which we do to take care of the credit periods, the opening outstanding receivables, payables, or an inventory, and the same thing which is there at the end of the year. We try to find the average. We try to find the average of this working capital, or in case of the tested party vis-a-vis of the comparable companies, and we try to adjust the margins. So does it mean that the working capital adjustment take care of the account receivable or account payable to a group companies? So the issue went on to the tax authorities in India, and they have their own view on the position as on this issue of outstanding receivable. The matter has actually went to the High Court, and the high courts have also given their view on the outstanding receivable. So in this discussion, I would be taking help of certain landmark judgments to present my view. Further, kindly treat this discussion as an academic discussion, because each case may be a separate case, and each case may need more analysis, and the judgments which I'm sharing may or may not be applicable on your case. But I'm sure, this discussion will help you in understanding the issue around the outstanding receivable. So to start with, what are receivables? What are outstanding receivables or account receivables? So in general, we all know it represents an amount which we need to receive, or which we have not received from our customers. So if I'm giving services to my customers, if they have not paid me and that amount is getting reflected in my balance sheet, it's the receivable, accounts receivable, or it may be called as outstanding receivables. So I've taken two, the meaning or the definitions from the online, websites, and as per the one definition, account receivable is defined as payments owed to a company by its customers for product and or services already delivered to them. And then we have a popular software, zoho.com, and the definition available on the website of the software is outstanding receivables denotes the amount that you are owed currently. That is the amount you are yet to receive from your customers for the products you sold them. This includes all invoices with the status sent, overdue, and partially paid. Now we have a judgment. So I will start with the judgment. We'll share the facts, and I'm sure these facts will help you in understanding the issues. The whole presentation can be divided into, as far as India is concerned, via Finance Act 2012, the specific inclusion was made to cover the outstanding receivable as an international transaction. So we have, period pre 2012, wherein the matter went to the courts, the tribunal, and the tribunal gave their view. Then we have the period post 2012, when the matter went to the court and court gave their view. Whether the outstanding receivable per se is an international transaction or not, that is, it should be considered as a transaction between two associated enterprises or not. And if yes, how to benchmark this transaction? So I would be covering all these aspects. So to start with, we have a tribunal, Bangalore tribunal. The case is of Logix Microsystems. The case went to the Bangalore tribunal. So before the case went to the tribunal, the TPO made an addition, and there was an outstanding of 7.73 crores at the end of the year. And out of 7.73 crores, 5.52 crore was for more than 6 months. So the transcribing officer observed, that the huge sum of money is parked with the associated enterprise outside India. It was in US. And if the SSC or the taxpayer would have brought this money in India, he could have invested well in some fixed deposit or with the bank and could have earned the money, could have earned some profits. And thus, the officer moved on to prescribe the addition. Against this addition, the taxpayer went to the CIT appeals and then to the Bangalore tribunal. For proposing an addition, the officer took a rate, SBI, the base rate, which we call prime lending rate, and then proposed an addition. Now, when the matter went to the Bangalore tribunal, the tribunal ruled in favor of the tax authorities and not in the favor of taxpayer. So what Bangalore tribunal said, let's read it. It says those receivable did generate from an international transactions carried. Therefore, there is no basis in arguing that receivables are strange to the international transactions. And therefore, those receivables would not come under the purview of the jurisdiction of the TPO. So very categorically, the Bangalore tribunal said, because they are animating or they are getting generated from the main transaction, which is an international transaction, and thus receivables also form part of the international transaction, and thus it is an international transaction. And certainly it comes within the purview of transcribing officer. That is, transcribing officer can evaluate the receivables. The outstanding receivable is the financial result of an international transaction concluded by the SSC company with its A in US, and therefore the income effect arising, if any, to that outstanding receivable is very much relevant aspect of ELP. I'm in complete agreement with the judgment from economic side, because when I'm entering into a transaction with my foreign AE, and as I said earlier, the credit period do have an impact on the pricing. So let's say, there are two parties, one party has given a credit period of 6 months, the another party is giving the credit period of 3 months. And let's say they both are charging $100 for a particular service. Then it certainly means the party which is giving the 6 months credit vis-a-vis the party which is giving the 3 months credit is charging the lower price. So certainly, the credit period do have an impact on the pricing of a transaction. And thus, when one is evaluating whether the transaction is at arm's length or not, one cannot ignore the credit period given to associated enterprises. This is what basically the Bangalore Tribunal observed. Further, the Bangalore Tribunal observed that it is also not seen from submission that the SSC was running its business with its own fund, and the SSC was not at all paying any interest in India for the borrowed funds. All the more, it becomes more important when you have a borrowed capital. When you are taking money from the banks, from third parties in your home country and giving the extra credit to your foreign A's. In such a case, it becomes more important because you have the interest cost coming in your profit and loss account, but you are not charging any amount from your A's. Or there may be a case that the price which you are charging is already taking care of the credit period which you have given. I think that is something which taxpayer needs to prove and document. So what the tribunal observed is the funds are repatriated into India on ordinary with the normal period. The SSC would have been in a position to pay all its working capital loan or other loans, if any, and or earning some income from an appropriate investment of those repatriated funds. This potential loss is definitely a factor to be considered while evaluating the financial impact of the international transaction concluded by the SSC. Therefore, we agree with the arguments of the revenue, that is the tax authorities, and upheld the findings of the TPO that an additional income is to be added in the present case as part of arm's length price analysis. So the tribunal ruled in favor of the revenue or the tax authorities that yes, it needs certain addition, or at least it needs the analysis. And we can skip this. So now we have the another judgment by Mumbai Tribunal in case of Nimbus Communications. And this judgment was in favor of the taxpayer and against the tax authorities. That is, the tribunal observed that it should not be considered as an international transaction. So on the debt outstanding for more than 30 days, the TPO applied 2.9% interest rate based on the LIBOR. So this was the brief fact, and the matter went to the tribunal. So what tribunal has to say? The question that we must address ourselves is to whether a continuing debit balance constitutes a transaction in terms of the provision of section 92B. We have a section in the Act. So whether the continuing debit balance or the outstanding receivable per se would become an international transaction or not, that is transaction which needs evaluation under arm's length price. So what Mumbai Tribunal has to say, I think Mumbai Tribunal said exactly opposite to what the Bangalore Tribunal said, we just saw. What Mumbai Tribunal said, a continuing debit balance in our humble understanding is not an international transaction per se, but is a result of the international transaction. Many factors, including terms of payments and normal business practice, influence the fact of payment in respect of commercial transactions. Unlike a loan or borrowing, it is not an independent transaction which can be viewed on a standalone basis. What can be examined on the touchstones of arm's length principle is the commercial transaction itself, as a result of which the debit balance has come into existence and the terms and conditions, including terms of the payment on which the said commercial transaction has been entered into. See, one may say that the Mumbai Tribunal is in favor of the SSC, that credit period or the debit balance or the outstanding receivable per se is not an international transaction, whereas the Bangalore Tribunal said yes, it is an international transaction. But this is more, I feel, is from a theoretical perspective, because at the end of the day, both the tribunals are saying one thing, that when you are evaluating a transaction, at that time you must consider the impact of credit period, directly or indirectly. This is what Mumbai Tribunal and Bangalore Tribunal are saying. So for the friends, who are watching this video, when you're doing transfer pricing analysis or doing transfer pricing documentation, the credit period or the impact of credit period on the pricing becomes important, and you must evaluate the same. Further, there may be a case, and you will often find this in while doing, while working on the practical case studies or while working on the clients, that let's say, one has agreed for 30 days credit period or a 60 days credit period, and accordingly they have built up their pricing. But one may not be receiving the money from associated enterprises within that time period. So for example, let's say if I'm dealing with my associated enterprises outside India, and the credit period that I have agreed is 60 days, but the fact may be I may be receiving the money after 6 months and not after 60 days. So the impact which I've already taken into my price is maybe of only 60 days and may not be of only 6 months. So these facts needs to be considered, needs to be documented, and one needs to evaluate them, while doing the comparison or while doing the arm's length analysis. So the further Mumbai Travel said the effect term of payment has to be considered vis-a-vis terms of payment set out in the transaction arrangement and not in isolation with the commercial terms. So the difference between Bangalore Travel and the Mumbai Travel, Bangalore Travel said, it would be considered as a separate transaction and it needs the benchmarking. Whereas the Mumbai Travel said, no, it needs to be subsummed with the main transaction, and whatever the terms and conditions are there, we need to see the impact on the main transaction. So apparently, the result might come same. Arithmetically, the result might come same, but theoretically, the travelers have two different views. Now, because of this confusion, we got amendment in the finance in the Income Tax Act and via Finance Act 2012. With the retrospective amendment, it was clarified that outstanding receivable will become an international transaction. So this para was added: capital financing, including any type of long-term or short-term borrowing, lending or guarantee, purchase or sale of marketable securities, or any type of advance payments or deferred payments or receivable or any other debt arising during the course of business. So specifically it was said, yes, that it will become the international transaction. Okay. Any question till now? Any point which you want me to clarify, which I have discussed till now?
Gauravji, I have just put one question in chat box. You see, where the terms were for 15 days of payment, but like pandemic happened and some other circumstances, the payment is delayed by, let's say, 6 months. What will be the status at that stage?
Okay. So now, let me see your question, sir. You're saying initially it was for 15 days, but due to some circumstances, the payment is delayed into, say, 6 months. I think a very good question. There can be a case that I have agreed for X period, and I took an example that I have agreed for 60 days and I got the payment after 6 months. And in this case, one has agreed for 15 days and one is getting the payment after 6 months. I think then one needs to see, this, sir, Tulji, can I park this question for the end?
Sure. Please.
But I think it's a valid question. Question. My tip is we need to evaluate the facts. So if one may need to charge interest for the additional period, or one may need not charge additional interest, I think that will completely depend on facts. And I will take this question. I will complete this. I will try to conclude this question towards the end of my presentation.
Sure, sir. Sure. Thanks.
Any other question, or shall I move forward? Any other question, friends, for me? Pratik is asking, can we get this PDF? Pratik, certainly I would be emailing the PDF or the presentation which I'm using to all the registered participants. So you will get it before end of the day. Then we have one question from Manishji, pretty long question. There has been now a standard practice in Bangalore ITAT to impute interest on any amount in excess of credit period. Very true, Manishji, and I would be covering that part. Okay, so I think let's move forward if you do not have any question. Okay.
गौरव जी ये जो ट्राइब्यूनल्स के अंदर डिफरेंस आ रहे हैं ना वो आ रहे हैं बिकॉज द फैक्ट्स कैन नॉट बी द एग्जैक्टली द सेम एंड ट्राइब्यूनल हैज टू एग्जामिन द फैक्ट्स एट द टाइम ऑफ द आर्गुमेंट्स so that could be the reason that they vary from one to another.
Very true, very true. So now see, let's see, once we have the specific inclusion in the act about that, that outstanding receivables will become an international transaction under the purview of any other debt arising during the course of business, what court has to see and what practically how we can handle all this situation. So the question comes, is outstanding receivable a separate international transactions? And the friends who are not from India, rather from outside India, let me assure you all this discussion would going to help you in managing your transfer pricing documentation too. Because whether there is a specific law or there is not a specific law, specific inclusion or not a specific inclusion, I just said few minutes back that the impact needs to be considered. So this is a Delhi High Court judgment in case of Kusum Healthcare, which was later on approved by the Supreme Court. In the Kusum Healthcare, the Honorable High Court of Delhi has said it would not become a separate international transaction. So let's read what the Delhi High Court has to say, and it is one of the landmark judgments which you will find, are referred by various councils and various, while putting up their submissions. The court is unable to agree with the above submission. The inclusion in the explanation to section 92B of the Act of the expression receivable does not mean that dehosts the context every item of receivable appearing in the accounts of an entity which may have dealing with the foreign aid would automatically be characterized as an international transaction. I think very beautiful observation by the court. That just because I've entered into a transaction with my foreign associated enterprise and I need to receive some money, automatically it would not be categorized as an international transaction. Now we'll go back to the fundamental that we discussed initially. That in general, while you do the pricing of your goods or services, you do take care of the credit period which you are agreeing upon. So if the credit period which I'm agreeing upon is 30 days or 60 days, 15 days or 6 months, I will try to take care that credit period in my pricing. So this is what court is saying, that not automatically. Not every outstanding receivable will be an international transaction, because I've already built in that, because it's a term of the transaction and not per se it is a transaction. And because it is term of a transaction, I've already built in the impact in my pricing. There may be delay in collection of monies for supplies made even beyond the agreed limit, due to variety of factors which will have to be investigated on case-to-case basis. So even if the delay is beyond the agreed period, as put in by Mr. Puri, the examples here, that wherein I have agreed for 15 days and I am receiving money after 6 months, the Honorable High Court says you need to go beyond and check what is the reason. Simply because there is a delay, you cannot say it is a transaction. So the Honorable High Court wants tax authorities and tax consultants to work more and do not simply go by statistics or Excel file. So very clearly the court says there may be a delay in collection of monies for supplies made even beyond the agreed limit due to variety of factors which will have to be investigated on a case-to-case basis. Importantly, the impact this would have on working capital of the assessee will have to be studied. In other words, there has to be proper inquiry by the TPO by analyzing the statistics over a period of time to discern a pattern which would indicate that vis-a-vis receivable for the supplies made to an AE. The arrangement reflects an international transaction intended to benefit the AE in the same way. Very categorically, the court is saying just because there is an overshoot, just because the actual payment is received after the credit period agreed, it does not automatically become the international transaction. So apparently, one thing is very clear, that the amount outstanding during the agreed period is certainly not an international transaction. And beyond that agreed period, I need to look into the facts and find the reason. What is the reason for delay? And whether I am giving any benefit to the AE or not. This is what the court is trying to say. If the answer comes, if I'm trying to give benefit by extending the credit period to my associated enterprise, then certainly one can say that it is an international transaction. Now, coming back to an example which Mr. Puri shared, that because of the COVID, because of the pandemic, there is a delay. Now, because of the pandemic, there is a delay. I think that is a normal phenomenon. And not only in a group company transactions, but I think across the businesses, there was a delay. And nobody charged, at least I have not seen anyone charging interest for such delay. So in my view, Mr. Puri, I feel it should not be, there is a valid reason, there is a genuine reason for this delay in your case. And one could take a position that should not be any additional charge or additional interest for such delay. Further, the court says, the court finds that the entire focus of the AO was on just one assessment year, and the figures of receivables in relation to that assessment year can hardly reflect a pattern that would justify a TPO concluding that the figures of receivable beyond 180 days constitutes an international transaction by itself. The court, the Honorable Delhi High Court, has very clearly said, just because the credit period is more than 180 days, it will not constitute an international transaction, and the tax authorities needs to do a thorough analysis before concluding that it is an international transaction. And this analysis needs to be qualitative and not quantitative. You cannot base your analysis only on the number of days. It needs to be qualitative. It needs to be driven by facts, driven by logic. What benefit? Because see, when it comes to the benefit, is very qualitative statement. So there must be quantitative factors that there is a delay, and there must be qualitative factor that yes, you are giving the benefit to your A, and then one would be able to argue that it is an international transaction. But this position is there in Delhi High Court, whereas as Manish has put in the question that the Bangalore tribunals are taking different view. I am in complete agreement. What Manish is saying, it's because of the Karnataka High Court judgment in case of the AMD India, wherein the Karnataka High Court agreed to the tribunal judgment. What happened, in the matter of AMD, for the extra credit period, that is the credit period more than the agreed credit period. So let's say the agreed credit period was 60 days. And instead of 60 days, the taxpayer received money after 180 days. So the credit period 180 minus 60, let's say 120 days, was considered as a international transaction in case of AMD by a tribunal. Against which the AMD, the commissioner went to the court, and AMD also went to the court, and the High Court dismissed the appeal. They never accepted this appeal, and it became sort of a mandate for the jurisdictional ITATs in Karnataka. And That's why you will find, Manish, if you will see the judgments of various tribunal, you will find the reference of AMD, the Karnataka High Court, wherein the extra credit period was considered as an independent international transaction. Now, to conclude both, what Delhi Tribunal has said and what Delhi High Court has said and what Karnataka High Court has said, I think one thing is clear. If something is happening within the agreed credit period, one can safely take a stand that yes, it is not an international transaction. It need not be benchmarked separately. So we need to start with, what in all circumstances we have exceeded the credit period and what is the reason for exceeding the credit period. So even if the credit period is exceeded, the question comes how to benchmark it, Manishi. So I go by, even if I go by Karnataka High Court, the extra credit period is considered an international transaction. But then question comes, what should be the price? Whether we should charge interest rate for this extra credit period or we should not charge that interest rate for that extra credit period. So that still needs to be evaluated. So any question till now, are we clear on whether it constitutes an international transaction or not? If anyone has any question on this point, we can discuss. Mr. Puri, am I able to answer your query?
Gaurav ji, see, दो मेरे केस में उन्होंने मैंने ये कुसुम का कोट किया था, तो the TPO said कि ठीक है सर आप अपील में ले लेना, मैं तो नहीं देता. I told him it is binding on you. Delhi High Court is binding on you and it can be held contempt. कहते हैं वो देख लेंगे, आप लोग उसको अपील में ले लेना. और दूसरी प्रॉब्लम ये आती है, उसका एग्रीमेंट में लिखा था for a period which shall not exceed 365 days.
Correct. Sir, see, one thing, I said earlier that there can be a case, and because it's a related party transaction, that if I'm agreeing for a credit period of 365 days, whether I have considered the impact of 365 days while doing a pricing or not is still a question which needs an answer. So probably a good documentation from a client's perspective, from a taxpayer's perspective, should also benchmark the terms of the transaction. And how to benchmark the terms of the transaction, we're going to see it now. But certainly from a legal perspective, the ruling is in your favor, and I'm hopeful you should get a favorable view as you move up the tribunal or as you move up the courts.
I also hope so. Thank you, sir. Thank you.
Now we have one question on YouTube from Rahul. Rahul is asking, as per 92B, receivables are also covered under the definition of international transaction, and TPO uses to make adjustment on receivable by computing notional interest after a general credit period. I think, Rahul, I have just completed this. There are two views which are going on. One view is by the Delhi High Court in case of Kusum Healthcare, which is generally followed, in most of the cases, wherein the court said, just because, you have exceeded the number of days, it may not still be regarded as international transaction. I think tax authorities need to work more to prove that it is international transactions beyond an agreed credit period. But certainly something which is happening within the credit period is not a transaction, even if I go by the Karnataka High Court. Then we have another question from Mahipal Singh Ranawat. Sir, would it be uploaded on YouTube? Mahipal ji, my discussion would going to remain on the YouTube. For getting the presentation, I think you can visit my LinkedIn profile. I would be uploading this presentation on my LinkedIn profile. If you are not there on my WhatsApp group, so all the friends who are attending, I have created one tax updates community on WhatsApp group. I would also be sharing this PPT in a PDF form in that community. So I may request you to join that community. I'm sharing the WhatsApp number 98.
Gaurav, I really appreciate that effort of yours. It is very beneficial. Thank you, sir. Thank you so very much.
I have shared the number, my WhatsApp number in the chat box, and you may join. You may ping me on a WhatsApp. I will share the presentation. Friends, those who are there on the YouTube, they may visit my LinkedIn profile after the discussion, or they may text their email ID to me, and I will send them the presentation. So now moving forward. So we have another beautiful judgment from Delhi Tribunal in case of Embry Price. We have seen the we have seen Kusum Healthcare, we have seen AMD, and there is another judgment by Delhi Tribunal in case of Embry Price. It says, EU contrary, the non-realization of invoice value beyond the stipulated period is separate international transaction whose ALP is required to be determined. So we have a Delhi High Court judgment which says beyond a credit period, it would not be regarded as an international transaction. And we have a Delhi Tribunal judgment which says it would be regarded as a separate international transaction beyond a stipulated period. I will try to create a balance between these two judgments. I personally feel, both judgments are beautiful, both judgments are very good. The only thing which we need to understand, what Embry Price is trying to communicate and what Kusum Healthcare is trying to communicate. This I will try to make you understand based on my understanding. So the question comes, whether it's an international transaction or not, if it is an international transaction, how to benchmark. And I apparently feel whether you take care of the same in your pricing or you benchmark it separately, arithmetically the answer should be more or less same. Just it may reflect how it may impact your presentation, but overall, whether there should be an addition or there should not be an addition, the answer would be same. So we have, in order to benchmark the transaction, we have broadly two options available. One is to carry out working capital adjustment, and second is to apply the comparable uncontrolled price method. First, we will see working capital adjustment. So in working capital adjustment, let's take an example. Let's say you are a captive unit. You are dealing primarily with your associated enterprises, wherein you are supplying goods or services to your associated enterprises, and you have a receivable outstanding, and you apply the working capital adjustment. And by doing the working capital adjustment, you are able to prove that your transaction is at arm's length. Means the margin which are coming after the adjustment is within the range, within the arm's length range. And because your margins after doing working capital adjustment are within the arm's length range, you're saying, hey, look, I am at arm's length. Same thing may happen in CUP, that you may say that the credit period which I'm giving to my associated enterprise is equivalent to the credit period which I'm giving to the third parties, and thus I'm at arm's length. The another case could be, let's say, if you do not have third party transaction and you're trying to benchmark using some comparable rate, some benchmark rate. So let's see what courts has to say on working capital adjustment. Again, a Delhi High Court in case of Kusum Healthcare. The court finds that the entire focus of the assessing officer was on just one assessment year, and the figure of receivables in relation to that assessment year can hardly reflect a pattern that would justify a TPO concluding the figure of receivable beyond 180 days constitutes an international transaction by itself. With the assessee having already factored in the impact of receivable on the working capital and thereby on its pricing profitability vis-a-vis that of comparable, any further adjustment only on the basis of outstanding receivable would have distorted the picture. Now, if we read this line, the court says with the assessee having already factored in the impact of the receivables on the working capital. Now, when the judgment comes, on a piecemeal system. There is a whole discussion which goes on various aspects, and then the court delivers the judgment. In this case, it's a very fact-specific case, wherein the working capital adjustment was approved by the court, and Based on this, probably the court said no, because working capital adjustment is applied and the results are okay. It should not be considered as separate international transaction, because what you are benchmarking is the terms of the transaction. But what if the receivables are not properly taken care in the working capital adjustment? So working capital adjustment takes care of, if you see the formula, it is dependent upon your opening balance. It is dependent upon your closing balance. Let's say, in order to deceive working capital, what you are doing, working capital adjustment, the transactions which are happened during the year, you are giving a credit of 11 months. But when it comes to the closure of year, you are settling all the accounts. So you have very thin working capital at the end of the year. Maybe a 1 month credit period, you can see the invoices raised towards the end of the year, maybe the March, are only getting reflected in the closing balances. But the invoices which you are raising in the month of April or May are getting settled, towards the end of the year. So they are not getting reflected in the closing balances. In such a case, can we apply the working capital? Because in this case, courts very well assumes, in the case of Kusum Healthcare, that the working capital is, the impact of receivables are already factored in the working capital. And there comes, Ambry Price, Delhi Tribunal judgment. It says it is axiomatic that the working capital adjustment is in respect of international transactions of rendering services to the AE. They agreed on it. Interest for the credit period allows, as per the agreement, is factored in the price charged for rendering of services. Granting of working capital adjustment is confined to the international transaction of rendering of services whose ALP is separately determinable. They are in line with the working capital adjustment. But now it comes a very important thing. The international transaction of interest receivables from its AEs for late realization of invoices beyond such stipulated period is a separate international transaction. Allowing working capital adjustment in the international transaction of rendering services can have no impact on the determination of ALP of the international transaction of interest on receivable from AEs beyond the stipulated period. Because what is stipulated will get captured in the outstanding receivable at the end of the year, but what is not stipulated may not appear on the opening or the closing balance. And if it is not appearing in the opening or the closing balance, it will not get factored into the working capital adjustment. There is one more fallacy in the reasoning given by the DRP about the subsumming of interest income in the working capital adjustment. It is simple that working capital adjustment is ordinarily computed by considering the average of opening and closing. This we have already discussed. And that's why the Embry price moves away from the working capital adjustment, and it moves away with regard to the period which is not agreed. And here comes the Karnataka High Court ruling, and here comes the Kusum Healthcare. I think now if you read Karnataka High Court, Kusum Healthcare and Embry price, I think the thread is, if something is forming part of your terms, and if you have something already taken care in the pricing, then it should not be regarded as a separate international transaction. But if something is not part of your term, if something which you have not agreed, then that extra period could be regarded as an international transaction. Now, there could be two cases. In general, if we are doing the delay in making the payment beyond the credit period, the other guy may charge an interest. Assume he may charge an interest. So where the comparable price suggests that the other guy will charge an interest, the supplier would charge an interest, I think therein we will say that it is a separate international transaction, the credit period beyond the agreed credit period. But wherein the comparable factor suggests no, there would not going to be any charge. For example, the pandemic period, there was no charge. So one can say it is not, the separate international transaction. Again, going by the Kusum Healthcare. Now, even if I apply Karnataka High Court, one needs to find the comparable rate. Even if I treat this extra period as a comparable, as an international transaction, then I need to still apply the comparable rate, and comparable rate for the pandemic was 0% because nobody was charging the interest. Secondly, the another aspect could be I have got internal comparables available. And I'm not charging interest beyond the credit period from even the third parties. Now, if I apply the Karnataka High Court says extra credit period would be considered as a separate transaction. Okay, that's fine. But what would be the comparable rate? If I'm not charging beyond agreed credit period from third parties, which means the comparable rate would be 0, and you can safely apply Karnataka High Court and multiply it with the 0%, the answer would be 0. But wherein I'm charging a rate from a third party, that rate maybe 2%, 5%, whatever you want to take, that rate would become a comparable rate, and that rate needs to be applied beyond a extra credit period, beyond a agreed credit period, and that will give you the addition. Now, similarly, there could be a case, wherein you do not have internal comparables. Then, we have the very authoritative ruling in case of the cotton naturals that in such a case, one needs to consider foreign currency, maybe the LIBOR or Euribor, whatever, and add some basis point. Maybe you may do the credit rating and everything, and then come out with the plus that you need to add, or generally, I have seen people add 200 to 300 basis point, and there are rulings which upheld LIBOR plus 300 basis points. So either you can take that approach. Now, there could be a scenario wherein there is an extra credit period, or there is a credit period, and the company is debt free. The service provider is debt free. Then what to do? We have a judgment from Honorable Delhi High Court in case of the Bactel, wherein the High Court has observed that in such a case, there should not be any interest. So what court says, as far as question B is concerning the adjustment for interest, interest on receivable, the court finding that the ITT has returned a detailed finding of fact that the SSC is a debt-free company, and the question of receiving any interest on receivables did not arise. Consequently, no question of law arises for consideration as far as this issue is concerned. This is what court said. With all due respect, I personally feel even if the company is debt free and there is a excess credit period, there is a credit period beyond the agreed credit period, or the credit period which is not as per arm's length scenario, in such a case, one should charge interest. This is my philosophy as far as arm's length is concerned. I have already shared what court has to say with due respect to the court. I think I'm done with my presentation on receivables, and if you have any query for me, feel free to ask. So we have few queries on the YouTube. Ashwin is asking how to benchmark receivables, which method to use. Ashwin, I think I have already discussed. Then we have Archita Shah. If the agreement mentions unreasonable credit period, intercompany agreement may itself be put to the test in terms of a 6-step process to delineate the transaction. Absolutely, Archita, that's what I said. We need to benchmark the terms also. Any other questions, friends, if you have for me, feel free to share. I'm hopeful that you may be liking the discussion and it must have been value add to you. So I would be uploading, I would be sharing this presentation on my WhatsApp group, on my LinkedIn profile. Plus, I would also be sharing this presentation with all the participants who have registered on a Zoom, and this discussion would be available on my YouTube channel. You can go watch and enjoy. So with this, let me end today's discussion. Once again, Very thanks to all of you for attending and namaste.
Gaurav ji, बहुत बढ़िया. Thank you very much.
Thank you, sir.
Thank you very much.